Um, Good afternoon, ladies and gentlemen, and members of the press. Um, the Monetary Policy Committee met on the 25th and the 26th of September 2017 against the backdrop of a relatively optimistic global economy. Committee examined the global and domestic economic and financial environments up to the third quarter of 2017 and the outlook for the rest of the year. The recent spate of flooding and hurricanes in some parts of the globe, the flooding in Nigeria, and the increasing tension between the US and the North Korea, as well as the perception of hostilities in the Korean Peninsula, and the associated geopolitical tensions were identified as key risks to global output growth at this meeting. On the domestic front, the economy exited recession, which began in the first quarter of 2016, during the second quarter of 2017, with a modest positive short to medium-term outlook, resulting largely from deliberate macroeconomic stimulus and a stable naira exchange rate. Inflation expectations also appeared anchored on the strength of prevailing tight monetary policy stance. 7 members of the MPC were present at this meeting. The external developments. Global output is projected to improve further in 2017 as growth forecast by the International Monetary Fund in its July World Economic Outlook was projected at 3.5%, up from 3.2% in 2016. Output growth in some advanced economies, including Japan, the Euro area, as well as some emerging markets and developing economies, is expected to improve in 2017. Nigeria, Brazil, and South Africa all exited recession, while Russia is likely to exit recession in the fourth quarter of 2017 after a mild contraction of 0.57% during the second quarter. Growth forecast for the US was revised downwards from 2.3% to 2.1% in 2017 as a result of the weak growth observed during the first quarter of the year. The MPC, however, noted some headwinds confronting the optimistic global growth prospects, to include recent developments on the Korean Peninsula, the damage to the infrastructure caused by the hurricanes Harvey, Irma, and Maria, the lull in Brexit negotiations, and the normalization of monetary policy by the US Fed, which is expected to instigate global capital flow reversals. Other challenges include the continued slow pace of recovery in global oil and other commodity prices, and China's reduction in uptake of global commodities. In addition, the committee noted the tepid global inflation momentum, implying that continued monetary policy normalization could be injurious to global growth prospects. The uptick in global inflation persisted but moderated in response to rising oil prices, continued accommodative monetary policy in the advanced economies, and currency appreciation in some emerging markets and developing countries. Average inflation for the developed economies is projected at 1.9% in 2017, while it is forecast to average 4.5% in the developing countries, as prices are expected to moderate due to seasonal effects. The committee observed that the outlook for global monetary policy remains predominantly accommodative in support of recovery and growth. Data from the National Bureau of Statistics showed that real gross domestic product grew by 0.5% during the second quarter of 2017 in Nigeria, against the contractions of 0.91% and 1.49% in the previous quarters of 2017 and the corresponding quarter of 2016, respectively, marking the technical exit of the Nigerian economy from recession. Non-oil real GDP grew by 0.45% during the second quarter of 2017, driven largely by agriculture 3%, industry 1.1%, construction 0.1%. The modest growth was attributed to fiscal injections from the implementation of the Economic Recovery and Growth Plan and enhanced supply of foreign exchange arising from improved crude oil prices. The committee also noted the positive outlook from the Purchasing Managers Index (PMI) for manufacturing and non-manufacturing activities, which stood at 53.6 and 54.1 index points in August 2017, respectively, above the 50 index points benchmark, indicating moderate signs of recovery. The committee further noted that although the recovery was weak, it was hopeful that the active implementation of the 2017 budget could boost aggregate demand and employment. Committee noted that money supply M2 contracted by 11.06% in August 2017, annualized, in contrast to the provisional growth benchmark of 10.29% for 2017. The development in M2 is largely due to the contraction of 18.42% in other assets in August 2017. Similarly, M1 contracted by 12.25% in August 2017, annualized, to 18.37%. Net domestic credit contracted by 0.14%, annualized at minus 0.2%, driven majorly by the net credit to government, which also contracted by 1.05% against the program growth of 33.12%. Credit to the private sector, however, grew marginally by 0.07% in August 2017, compared with the provisional benchmark of 14.88%. The MPC also noted the policy constraints in ensuring the flow of credit to the real sector in the face of weak and underperforming monetary aggregates. Inflationary pressure in the economy continued to moderate, with headline inflation year-on-year receding for the 7th consecutive month to 16.01% in August 2017 from 16.05% in July 2017. Food inflation declined slightly to 20.25% in August 2017 from 20.28% in July 2017, while core inflation increased to 12.3% in August 2017 from 12.21% in July 2017. This development was attributed to the contraction in money supply, decline in imported food and non-food prices, favorable base effects, and the moderating effects of stable exchange rates. The committee, however, noted that the high food inflation was traceable to rising prices of farm inputs and supply shortages, intermittent attack by herdsmen on farmers, as well as weak harvest due to increased flooding of farmland. Money market interest rates oscillated in tandem with the level of liquidity in the banking system, as the average interbank core rate, which opened at 18% on July 26, 2017, closed at 7% on August 31, 2017. The open buyback rate, OBB, opened at 15.03% and closed lower at 7.83% in the same period. However, the average interbank call and OBB rates for the period stood at 22.63% and 39.66% respectively. The movement in the net liquidity positions and flows reflected the effects of open market operation sales, foreign exchange interventions, statutory revenue payments to states and local governments, remittances by Nigerian Customs and the Federal Inland Revenue Services for FAC meetings and the maturity of CBN bills. Committee noted the continuing improvement in the external reserves position and the equities segment of the capital market. External reserves position grew to $32.9 billion at close of business on the 25th of September 2017, while the all-share index rose by 7.2% from 33,117.48 on June 30, 2017 to 35,504.62 on August 31, 2017. Market capitalization improved by 6.9% to 12.24 trillion naira from 11.45 trillion naira during the same period. Relative to end of December 2016, capital market indices rose by 32.1 and 32.3% respectively, reflecting growing investor confidence due to improvements in foreign exchange management. Total foreign exchange inflows from the CBN rose by 1.98% in August 2017 compared with the previous month. Similarly, total outflow increased by 7.03% during the same period as a result of increased international remittances, inclusive of public sector and JVC payments, which rose by 58.59% in the period under review. Committee noted the trend towards convergence between the rates at the Bureau de Change and the autonomous foreign exchange market (NAFEX) segments, as well as the stability of the exchange rate at the interbank segment of the foreign exchange market during the period under review. Similarly, the committee noted the success of the investor and exporters window of the foreign exchange segment and traced this not only to foreign investor confidence but also to the zeal and commitment of Nigerian exporters who have demonstrated preference for the window to the parallel market. Committee observed that the investor and exporters window has increased liquidity and boosted confidence in the market with over $7 billion inflow in the last 5 months. The committee will continue to introduce policies that will improve the confidence of foreign investors in the country's macroeconomic management regime. Overall outlook and risks. Available data and forecast of key macroeconomic variables indicate a relatively positive outlook predicated on existing policy initiatives including the Economic Recovery and Growth Plan. Other potential drivers of economic recovery are the expected increase in government revenue arising from favorable crude oil prices, stable output, and general improvement in the non-oil sector, especially agriculture, industry, and construction. The intervention by the Central Bank of Nigeria in the real sector is expected to continue to yield positive results in terms of output and lower consumer prices. The committee, however, noted some downside risks to the overall short to medium-term positive outlook for the economy. These include flooding, which displaced farming communities and political agitations. On the external front, the hawkish policy stance in the United States, rising geopolitical tensions and sluggish output recovery in the Euro area and Japan could slow down the momentum of global output growth, with significant spillovers to emerging markets and developing countries, including Nigeria. The considerations of the committee. Committee applauded the exit of the Nigerian economy from recession, but observed that the growth remains fragile and therefore hopes that complementary fiscal and monetary policies will sustain the growth momentum. The committee further expressed satisfaction with the gradual but consistent decline in inflation, noting, however, the substantial base effect in addition to the continuous improvement in the Naira exchange rate across all segments of the foreign exchange market and considerable improvement in foreign capital inflow. Committee welcomed the gradual implementation of the 2017 budget, especially the capital component of the budget, and urged increased momentum in expenditure directed at the growth-stimulating sectors of the economy in order to reduce youth unemployment and restiveness. The committee, however, expressed concern on the sustained pressure of food prices, noting risks posed by floods, strikes, and insurgencies in various parts of the country to food production and distribution. Regarding the tepid turnaround in economic activities in the second quarter of 2017, committee emphasized that the employment gains of recovery were still minimal, noting that a number of important job-elastic subsectors were still weak and may require more fiscal support to regain traction. The committee, however, commended the federal government for issuing the executive order aimed at improving the ease of doing business in the country. It also noted the efforts of the government to create jobs in the agricultural sector, with the inauguration of the Presidential Committee on Jobs Creation, targeting at least 10,000 jobs in each state of the Federation over the next 6 months through a boost in agricultural support and funding. The committee enjoins the state governments to work with the Presidential Committee to actualize this plan without further delay. MPC also noted with satisfaction the directive of the federal government to all states to promptly pay outstanding salary arrears in order to boost aggregate demand. It commended efforts to clear outstanding contractor arrears, prompt settlement of trade disputes with certain unions of organized labor, including the Academic Staff Union of Universities and health workers, as well as the release of money to settle outstanding entitlements of the erstwhile workers on defunct Nigerian Airways. These efforts, the committee reasoned, would improve aggregate demand and further strengthen the weak recovery. MPC restated its commitment to maintaining stability in prices, without which meaningful recovery cannot be achieved. In this regard, members welcomed the gradual narrowing of rate spreads in the foreign exchange market and urged the bank to continue to monitor and respond proactively to threats and vulnerabilities in the foreign exchange market. On the outlook for financial stability, the committee noted that in spite of the banking subsector's resilience, the weak macroeconomic environment has continued to impact negatively on the stability of the subsector. The committee reiterated its call on the bank to sustain its surveillance of deposit money banks' activities for the purpose of prompt identification and mitigation of potential vulnerabilities. Committee also called on deposit money banks to support the quest to move the economy forward by extending reasonably low-priced credit to the private sector. In arriving at its decision, committee took note of the gains so far achieved as a result of its earlier decisions, including the stability in the foreign exchange market and the moderate reduction in inflation. The option was whether to hold, to tighten, or to ease. These were subjected to extensive debate. As in previous meetings, although tightening would help rein in inflation expectations and strengthen the stability in the foreign exchange market, the committee felt that it would further widen the income gap, depress aggregate demand, and adversely affect credit delivery to the private sector. The committee also noted that tightening may result in the deposit money banks repricing their assets and loans, and thus raising the cost of borrowing and therefore heightening the already weak investment position and non-performing loan condition of bank customers. With respect to loosening, committee believed that although it would make it more attractive for Nigerians to acquire assets at cheaper prices, thus increasing their net wealth and therefore stimulate spending as confidence rises, it nevertheless felt constrained that loosening at this time would exacerbate inflationary pressures and worsen the exchange rate and inflationary condition. Committee also felt that loosening will further pull the real rate deeper into negative realm as the gap between the nominal interest rate and inflation widens. On the argument to hold, the committee believes that the effects of fiscal policy actions towards stimulating the economy have begun to manifest as evidenced in the exit of the economy from the 15-month recession. Although still fragile, the fragility of the growth makes it imperative to allow more time to make appropriate complementary policy decisions to strengthen the recovery. Secondly, committee was of the view that economic activity would become clearer between now and the first quarter of 2018, when growth is expected to have sufficiently strengthened and gains in receding inflation very obvious. The most compelling argument for a hold was to achieve more clarity in the evolution of key macroeconomic indicators, including budget implementation, economic recovery, exchange rate, inflation, and employment generation. In consideration of the headwinds confronting the domestic economy and the uncertainties in the global environment, the committee decided by a vote of 6-1 to retain the monetary policy rate, MPR, at 14% alongside all other policy parameters. In arriving at this hold decision, the MPC commits to employing maximum flexibility to guide the economy on the path of optimal growth. Consequently, 6 members voted to retain MPR and all other parameters at their current levels, while 1 member voted to lower the MPR to signal an ease to the current stance of tight monetary policy. However, overall, majority of the members expressed a strong commitment to policy flexibility that would allow the committee to promptly take the necessary actions that will promote overall macroeconomic stability and engender sustainable growth. Consequently, the MPC voted to 1. Retain the MPR at 14%, 2. Retain the CRR at 22.5%, 3. Retain liquidity ratio at 30%, and 4. Retain the asymmetric corridor at plus 200 and minus 500 basis points around the MPR. Thank you for listening.